Hi, Ron Harrison here with Unlimited Success Financial, and I'm here to talk to you today about a secure financial future. And so many of us these days are worried about inflation, about global economics, about uh, United States politics, and we really don't know what our financial future might look like. So wouldn't it be great if you could at least have part of your financial future be really secure? When we start talking about financial security, there are only two aspects to financial security. The first one is never having to worry about your next check, whether it's a weekly check, twice a month, monthly, annually. If you knew exactly what that check is, then you'd have much more peace of mind financially, right? And knowing exactly how much money you will get every month will give you much more peace of mind. That's probably 90% of the anxiety we have about money are those two things. But when we work with protected income retirement plans, those are plans that give people those two aspects of financial peace of mind. First of all, the money is not at risk in the market, so that way you know exactly how much money you're going to have. Second, it locks in all the gains. So every year when you get your gain, that is locked in, can never ever be lost, nor can your principal be lost. Again, that lets you know exactly how much money you're going to have. The third thing, it grows tax deferred. So as it grows and grows and grows and grows, Uncle Sam does not reach in to take your money. That way you know exactly how much money you're going to have, right? And then finally, these things can be funded in a variety of ways. They can be funded with cash that you might have in your gun safe, or maybe an inheritance or retirement rollovers. A lot of people transfer their mutual fund accounts to these secured plans because they're tired of the stock market roller coaster. And nobody wants to be on a roller coaster when we're talking about our financial security, do we? That could be a losing game for sure. If you think about 2002 and 2003, 2008, if you think about March of 2020, and then if you think about the first 4 months of 2022, that market was on a slide, wasn't it? Nobody wants that. So when we start talking about the secured financial future, let's look at how people allocate their financial assets. And this is industry-wide in the financial industry. There are really three buckets of our cash assets. First of all, a lot of people have money in bank CDs, savings accounts, and money market plans. And the money market plans, those are sort of like a savings account. You're not going to lose any money, but you're not going to make much money. Now, a lot of times those plans get taxed every year, even on the little bit of money you make. A lot of people have money in their gun safe at home, so they have liquid cash available, or they hide money under their mattress. And don't laugh at this, but there are people who have thousands of dollars under their mattress or under a floorboard in their house or in a coffee can out in the yard or something like that. Well, the thing with this bucket of money, there's no risk, and of course there's no reward. You're not earning anything on your money. Now if we take a look at the middle allocation that a lot of people have, money in bonds like municipal bonds or corporate bonds, those things are really a good hedge against loss. Now, corporate bonds can crash, municipal bonds can crash, but in practice, in general, there's no risk to those things, and you have a secure reward. The tax-free retirements that we help our clients with are the same way, no risk, secure reward. And then the safe income plans that I'm specifically talking about with this presentation have no risk and have secure reward. Now let's take a look at the risky side of our money. Look at the risky side, the 401ks we have at work, traditional IRAs that are in the stock market, and Roth IRAs that are in the stock market are at risk, mutual funds, commodities like gold, oil, silver, those sorts of things, brokerage accounts. All of those things are typically at risk. Now, since they're at risk, and it could be high risk, right? Look at 2008 when people lost 40% of their money. But with high risk, there's the possibility of high reward, but there's also the possibility of great loss. And here we are in May of 2022, and people have lost, or the stock markets, S&P 500, the Dow, the NASDAQ, they've lost anywhere from 12 to 25 or 26% in 4.5 months. People have seen their 401ks turn into a 201k, right? So when we think about these allocations, it's not smart for people to have a lot when they're older to have a lot of their money at high risk, isn't it? So let's look at some age-based allocations for diversification. So first of all, and this is standard across financial industry, these sorts of numbers. From 25 to 45, you probably want to have about 10% of your money in cash or something that you can get to very easily. About 25 to 45% of your money you want to have in something safe, bonds or safe income plans like we do, or tax-free retirements. Then finally, at that age, you have time to make up for loss. So 45 to 65% of your money you could have in some of these risky plans. Now you get a little bit older, you're secure in your job, 45 to 55, still the 10% allocation in cash is a good thing to have. But you want to start moving your money from risk into lesser risk. So you can see that you might get 45 to 50% of your money in bonds and in the safe money areas. Then finally, you can still afford to have some money at risk because you still have some years where you can make up for loss. Now as we get into our 60s. Into our 60s, again, you want to have that 10% liquid cash easily to access. You want to start moving into more bonds and more to the secure money, and then finally take money out of risk, because at 63, 64, 65, you don't have years to make up for loss. Do you know that often, let's say the market drops 20% in a year, it might take 2 years for you just to get back to level. Well, when you're 63 years old, you don't want to have to work extra years just to get your money back. So you want to start looking at these age-based allocations and diversification, start moving your money. Now the trend you can see here, check this out. It's very easy to remember this stuff. Whatever age you are, that is the percent of money you should have in bonds. So at 55 to 65, you want to be at 55 to 65% in bonds. Of course, this isn't for everybody. People are different, but just in general, the average person, you want to make sure you're moving, as you get older, move from risk into more safe money. And then finally, so we start taking a look at the last category. So 65, you're retired. You're up to, until you pass at 90 years old. Of course, you want to have so much of your money, some people even nearly 100% of their money, in things that will never, ever, ever lose a penny. Wouldn't that be smart? And then on the risky side, you might have zero money in risk, or might still have up to 20 or 25% of money in risk. But these are the things to think about when you're starting to talk about getting a secured retirement. Now, the thing that we're going to talk about next, you can see just highlighted right here, we're going to talk about index accounts, and we're going to talk about a specific indexed account for people who want to have really nice guaranteed returns and never ever lose a penny, know exactly how much money they have later in life. So first, let's talk about how indexed accounts work. So indexed accounts, the blue line, this is index plans. The index plans, they go sideways when the market crashes, and they go up when the market does well. They lock in the gains every year. So you can see right here in 2002, 2003, and then of course in 2008, you can see what happened. Now, the last 3 or 4 years, we've had a 10-year, essentially a 10-year bull market. The stock markets are catching up to the index plans, but look at this huge gap. In these index plans, we're only showing credits at about 8% annual cap, because you have a zero floor, you can't lose. You have an 8% cap, so you don't get all the top side, but you get most of it. So let's look at the features over here. You get off the financial roller coaster. It's indexed to the market, so you get market-like gains when the market goes up. Typically, it's indexed to the S&P 500. You can see the S&P 500 performs better than the Dow over time. You lock in all the gains. You can never lose the gains, nor can you lose your premium when the market crashes. You have never fight back from loss. Principal never lost. Never can be lost. You have liquidity when needed. You can provide lifetime income that we'll talk about in a minute. And obviously, this will give you financial peace of mind. Isn't it awesome if you knew that every day, every month, every year, that your money either goes up or it stays the same? You can never have loss. That would be peace of mind, right? Now let's take a look specifically at the type of plan that we do. This is called the Safe Income Advantage Index Plan, and this is an index income account. What that means is that this will provide you income for the rest of your life. So if you look over here at the features, it's designed for lifetime retirement check, a check every month for the rest of your life, no matter how long you live. But if you pass too soon, you pass early, then the money goes to your beneficiaries. It's a set it and forget it plan. You know exactly how much you'll have later in life. You remember the 2 rules we looked at the beginning of this, knowing exactly how much money you have? That's what this does for you. Provides financial peace of mind. Money is not in the market. The stock market, the S&P 500, is used as the measuring tool, the barometer. Never lose value due to the market volatility, liquidity in emergencies, and you can turn on income whenever you want to. So in this example, person had $100,000 at 63. At 67, it's grown to $141,000. You can see they've earned 7.2% every year. So if the market drops 20, you're 27.2% better than the people who lost 20% in the market, right? And the money grows up. Say they wait till they're 72, they have 200,000 in here, and then they could turn on a monthly check for the rest of their life. It's based on the age that they turn on their income. Now, I just have these ages here just to show us. These could be any ages. Now let's take a look at some more specifics on the money. Now here, I just wanted to show people how 100,000 could grow. We looked at that previously, 300 and 500. And of course, since we know that every one of these accounts gets 7.2% every year, really all we had to do is just take this 100,000 amount and multiply it by 3 or multiply it by 5 to get down here. And it works out within about $2 or $3 because it's all based on the exact amount of money at 7.2%. So you know exactly what you have. But wouldn't it be great if, say, you had an old 401k, 500,000, or part of an old 401k, maybe have $1 million in a 401k. So you know what? I'm going to take half of my $1 million and I'm going to put this in a safe money plan. And you will know exactly 5 years from now, you'll have 700,000. 7 years from now, 800,000. 10 years from now, you'll have over $1 million absolutely guaranteed. Then the rest of your money could be in the risky stuff, growing more money for you, or in other plans. So this allows diversification. So I hope that helps you. And before we get out of here, I'm going to go back to one of the slides, back to the original slide. So again, remember, this is absolutely guaranteed money right here. And at the end of year 10, we just call the company and say, hey, please write my client a check for every month for the rest of their life. So if I go back to our original screen here, these plans we do, never worry about a paycheck because you will get a paycheck every month and you know exactly how much money you will have 3, 5, 7, 10, 15 years from now. So thank you very much for watching. The next step would be to get a hold of me. Here's my information up here at the top. And I can talk to you about some specifics for what your goals are for your retirement. Thank you very much for listening. Have a fantastic financial future.